Hey hamsters, seeds for seeds, money for Bitcoin, crypto for gains? Today we're diving into the different types of trades and when you might see them in the wild world of crypto investing. Time to burrow in as we learn the nitty-gritty of the 5 most common. First up is spot trading. Spot trading in crypto is like striking a deal at a bustling market. Let's illustrate. You make an offer to trade your sunflower seeds at a specific price. At the same time, one of your fellow hamsters sets their own price for the sunflower seeds they are offering. All of the offers to buy the sunflower seeds and prices of your sunflower seeds are then displayed in a market that everyone can see. Then, when the selling price of the sunflower seeds matches a buyer's request to purchase seeds, the trade happens instantly. Similarly, imagine 2 traders locking in a price to buy or sell their favorite crypto tokens, be it Bitcoin or Dogecoin, right on the exchange. The price they agree on? That's the spot price, and it's all about getting those tokens instantly. This means in the world of crypto trading, it's just like finding the perfect sunflower seeds exchange in the hamster market, except instead of trees, you are trading Bitcoin and Dogecoin. Important to note, spot trading is considered one of the most straightforward methods of trading, and is less risky than some of the other types of trading we will be looking at today. Specifically, futures. Futures contracts are like placing a bet on how fast a wheel will spin at a certain time in the future. For example, you might guess that one wheel will be spinning faster than another wheel by the time the race finishes. If you are right, you win. If not, you lose your bet.
No, I don't want to go! No!
Similarly, in the world of crypto, futures are special deals where 2 investors make a wager about the price of an asset, like Bitcoin or ETH, on a specific date down the road. Each futures contract comes with its own set of rules, including how many units are involved, how the pricing works, what you need to set aside as a margin, and how the final deal gets settled. Then, depending on the crypto's price, you've got a couple of options. You can either keep your futures contracts rolling or swap them with another hamster for a fresh deal. When your contract's time is up, you can choose to roll it over to a new contract or let it expire and grab the cash settlement that's due. The big win with Bitcoin futures is that they give you a regulated way to dive into the crypto scene in a market that's as unpredictable as a hamster on a sugar rush. Having that regulation is gold. CME's Bitcoin futures are watched over by the Commodity Futures Trading Commission, CFTC, which means there's a safety net in place. This regulation gives investors that sense of security and some extra protection. Imagine you are using a special hamster wheel that only lets you use a certain amount of your sunflower seeds for one specific spin. That's what isolated margin is all about. It's a way of trading where you set aside just a chunk of your funds to back one particular trade, keeping it separate from all your other trades. So if your trade goes haywire or zooms to success, the risks and rewards stay with that one wheel. It's like having full control over your sunflower seed stash for each wheel spin, making sure you know exactly how much you are risking and potentially earning. So when would you use it?
I don't know.
Traders like this strategy if they want to engage in high-risk strategies or are trading volatile assets. Let's say a hamster has $10,000 worth of seeds in their stash and decides to use isolated margin trading to manage risk. So the hamster spots a golden opportunity with Bitcoin priced at $40,000 each and decides to use 10x leverage to buy 2 BTC. With $8,000 backing this trade, they're a riding high. Lucky hamster watches as Bitcoin's price climbs to $45,000. Their 2 BTC are now worth a sweet $90,000. The hamster decides to cash in and sells the BTC, ending up with $20,000 in their stash an initial $10,000 plus a $10,000 profit. Keep in mind that the hamster will also have to pay a fee for the leverage that platform provided to make the deal happen. But if Bitcoin's price had tanked to $35,000, that 2 BTC would now be worth $70,000. That's a $10,000 loss compared to their $40,000 buy price. When the price reached $36,000, the market faced a margin call and the position was liquidated. Yet since they used $8,000 as collateral, they had the $2,000 not involved in the trade left. Now let's see how cross-margin trading would play out in this case. In the case of the cross-margin trading, they're putting the whole $10,000 up as collateral for their trades. It's like using every last bit of their sunflower seeds to back up their bets on the price of sunflower seeds in the future. If the price goes up, the hamster will make $10,000 in profit, $20,000 overall, notwithstanding the leverage fee, of course, the same as with isolated trading. But here's where the wheel spins differently. If Bitcoin's price tanks to $35,000, the margin call happens at $35,000 and not at $36,000, which means the hamster will lose all of the money they put as collateral because 2 BTC is now worth $70,000 and not $80,000 as it had been when the trade was initiated. The hamster's account wouldn't cover the loss, and they'd be in a sticky spot with no extra seeds to spare. In such cases, many trading platforms might give the hamster a margin call, which is like a request for more seeds to cover the loss. If the hamster can't add more seeds or shrink their position, the platform might automatically close part of their position to stop further losses. So, in the world of cross-margin trading, it's all about how much you are willing to risk and making sure you are prepared for those wild price swings.
I'm not scary.
This might appeal to you if you want more leverage and larger positions. Let's picture a scenario where the odds are totally in your favor and you're ready to make the most of it. That's leverage trading in a nutshell. It's like borrowing extra seeds to power up your wheel and make even bigger trades. Here's how it works. You use your own stash of seeds plus some borrowed seeds to make trades. The ratio of your seeds to the borrowed seeds gives you leverage. If your trade goes well, those borrowed seeds can multiply your winnings. The caveat though is that if the trade goes sour and the value of your position drops, you might get a margin call. A fancy way of saying you need to either add more seeds or sell off some of your wheel. So, what are the risks? The biggest risk is forced liquidation. For this reason, leverage trading is pretty high stakes, so it's best suited for experienced hamsters who know their way around market swings and can read the right indicators. So, if you are thinking of taking your wheel to the next level, just remember, leverage trading is like playing with a bigger pile of seeds, but it comes with some serious risks. Thanks for watching, subscribe and remember, hamsters are power, one for all and all for one. Bye!